Good afternoon or good morning. Honored to be on this panel to cover this timely topic on how mature ESOP companies address repurchase liability and grow by using their excess cash and facing the challenges it takes to grow and also manage this repurchase liability by partnering with a family office. To my right is Jim Massey. To my left is Colin Patrick. My name is John Cober. I'm a partner at Morgan Lewis, and I spend a significant amount of my time dealing with these types of issues, advising family offices, private equity, as well as ESOP companies, and have been through a number of these types of transactions. And I will say, if structured right, they're very, very successful. At this point in time, I'm going to let Colin introduce himself, and then Jim, and then we'll jump into the program.
Hello, Colin Patrick. Little background, I started my career at Deloitte as a CPA and joined a local family in Dallas, the Hunt family, a pretty large family. Helped them with their investment portfolio. Acquired my CFA, Chartered Financial Analyst, about 10 years ago. And then I joined the Hunt for Patterson Thoma family office. And a little background on Patterson Thoma. Our principal, Dan Patterson, built a career of private equity and leveraged buyouts. And over the years, we decided that what he learned in the private equity side on the LBOs with outside investors, we internalized a lot of the success in the family office, but we no longer had the time horizon constraints that a lot of investors do. So we're able to implement the same successful business plans, but invest literally for generations. And that allows us to work with the best management teams over long periods of time without a constraint to exit necessarily.
Thank you, Colin. Jim, can you tell everybody probably knows who you are, but please spend a couple of minutes on.
Yeah, I'm the old guy in this threesome here. I've been around for a few years. So great to see everybody, or great to join everybody. I want to thank Michaels for inviting me to be part of this presentation. Happy to be involved. Before joining Morgan Stanley, I enjoyed a 35-year investment banking career where I really focused on assisting business owners, middle market size company business owners who are looking to execute some sort of business succession strategy. So ultimately, these sorts of strategies culminated in some sort of liquidity event for the business owner. So what types of transactions have I been involved in? Everything from a recap where the company on some leverage and the board of directors issue a special dividend to provide liquidity to the selling shareholders. The other types of recaps involve private equity coming in and purchasing a minority interest in the private company. And of course, the other types of transactions involve a full 100% sell to either strategic investors or financial investors. So all those strategies, great for the selling shareholders, perhaps beneficial to a select few employees. But what's wrong with that picture? What about all the other majority of the employees in the company? And that's exactly why I liked advising companies that wanted to structure an ESOP transaction, either a 100% sale to the employees of the company or perhaps a minority sale to the employees of the company. And now that I'm with Morgan Stanley, we have a huge interest in ESOP companies. In fact, statistically, we have over 600 companies that are clients of the firm. And then just this year alone through October, we've actually worked on 65 ESOP transactions. So ESOPs we're quite active in, and I think with the baby boomers retiring at age 65, many of those folks own businesses that will have to go through some sort of business succession. So I think we're going to be quite busy for the next 10 years or so.
Thank you, Jim. Thank you, Colin, again. Let's jump into a fact pattern, which I think Jim and Colin would say what we've encountered in the ESOP area. There's a lot of great ESOP companies that are 100% owned. What we've encountered in bringing and combining family office, and Colin and Jim will talk a little bit more about the differences between private equity and family office, why it's such a great fit for many companies, is you run into an ESOP company that's had a lot of success over the years, but they're a mature ESOP companies. Many of these were set up in the 70s, 80s, 90s, early 2000s. And all of a sudden, they've had so much success, but they've built a great culture for their employees. They've got a great management team, but they're faced with a couple of challenges that they're trying to find a way to achieve continued growth and keep the team together, as opposed to selling the company either piecemeal or in whole to a public company or to another private equity company, which we do see. And so one of the things we look at is, how do we meet the challenge of satisfying repurchase liability? Because as we know, ESOP companies have these bubbles, and they can be some long bubbles, which really demand cash because your employees want cash. And the second thing is, when that demand for cash comes in the form of repurchase liability, Murphy's Law always prevails. There's some great opportunity to grow organically. It may be a must for the company to sustain itself in the industry. It may be for acquisition opportunities. And how do we put together a platform where we can satisfy growth at the same time of repurchase liability? One of the things I'm going to kick over to Jim is I've had really the privilege and honor to work with Jim on many transactions, and we've looked at this. And I would ask everybody to turn their slides to page 23, because this is really the structure we're going to look at. Is, Jim, when we first dealt with this, we used to dial senior bank. Then we used to dial senior bank plus mezz. Then we thought about, what about these private equity groups? And then we thought about other things. What are you seeing in the marketplace with regard to these types of situations? Because many of these companies don't want to sell, they want to perpetuate themselves. So
yeah, absolutely. You know, in my collective experience working with ESOP companies that are in this sort of predicament, you know, it's the companies that first and foremost, at some point, that repurchase liability obligation is going to increase. And what I find in the marketplace is that, you know, the transaction closes, everybody takes this big sigh of relief. They're excited that the employees now own the company, but they don't really think about the repurchase liability. Some companies do, however, and they use really detailed cash management to match the cash needs in the future for the repurchase obligation. They also use different types of insurance products that build cash value fairly quickly to be able to address those looming repurchase liability. But then as far as what I've seen in the marketplace, you know, private equity has traditionally played a big role when companies are wanting to grow and manage their cash and make acquisitions. But the interesting thing about private equity, and believe me, I have a ton of friends that are in private equity, some of my best friends. There's so much capital right now with private equity funds, and they're chasing so many deals, and they're constantly reaching out to owners of private businesses, almost to the point where I have many clients that own businesses that say that they get calls, maybe 10 calls a week from private equity, especially if you're in a sector that draws a lot of attention from private equities. And so, generally, I think because there's so much capital out there trying to find a home, I think a lot of these business owners are a little gun shy of private equity. And that's why I'm so excited to really have Colin here with us today, representing a family office, because I think it's the new trend in the marketplace as far as solving a lot of problems and having a really long-term capital partner to help fund some of the initiatives that companies want to do that are already ESOP structured in an S corp entity. So I'm really excited to talk about this, walk through the structure, and have Colin's input on some of the dynamics behind why it's really a good a private equity, a private family office group is a good capital partner to fund a lot of initiatives that companies have.
Thank you, Jim. Colin, Jim and I do a lot of talking here. So why don't we take a step back, and why don't you tell us a little bit about what a family office is, and then Patterson, Thoma, because the audience is going to be quick learners on this, in the sense they're going to be very interested in see how do we use this, and then we'll talk a little bit about some of our strategies.
And also, what are the different characteristics of a family office investment appetite versus private equity?
Certainly. So a family office generally is a team of professionals. Sometimes they're family members, but oftentimes they'll bring in-house, whether it's accountants, lawyers, other financial advisors that can help families manage their portfolios. They can also help with personal residences or succession planning, trust, coordination, wills, estates, ideas like that. But each family office is unique, and each have different goals, right? There are certain families that have 6, 7 generations of wealth later. You can imagine how that family tree is expanded so wide that a lot of times the images for the family that created the wealth, maybe that company's gone and the liquidity trickles down. And so to be specific about the family that I work with, Patterson family, Dan Patterson started leveraged buyout shop, as I mentioned, early 90s here in Dallas, and over the decades has been able to monetize dozens of those. And along the way, learned a lot of different industries, whether it's manufacturing, technology, education, healthcare, and really just created a fabulous Rolodex of management professionals, superstar operators, solid investors, good banks, and made a very successful career out of that. The deal with private equity, to kind of bring in some of Jim's points, is it's very hands-on. It can be a very heavy lift to have a good, successful outcome. So for us, now we say we're not operators, we're allocators. And to be good at allocating, we have to find the best management teams to allocate to. And so that really brings us to the ESOP company, which already has achieved several objectives. One, it was successful enough for the founders to grow something, and B, have something to turn over to the employees in this next group, next wave of managers and owners. So the company's already proven success, right? So that's good. 2, you have the body of so many employees, maybe even all of them. And so that creates a great alignment of interest, knowing that you're in it for the long haul as well. So I'm over here representing a family in generations, parents, children, grandchildren. They're in for the long haul, you're in for the long haul. So that makes a really good partnership from that standpoint, and the fact that we all want this to go forward, in the long term successfully. Then you layer in maybe the other structural components, which we'll get to on the time horizons or the cash flows, and the fact that sometimes these ESOP plans end up with these great ideas for acquisitions, whether you're creating a new product line, so an organic initiative or potentially an acquisition of an existing outside company that might be a good add-on or complementary to your business. And so you have those cash needs. For us, we have cash that we're trying to deploy with talented teams. And so you layer that in with not just the cash, but also our experience in transactions like this, I think really makes a natural fit for ESOPs and family offices looking to do a deal together.
Let me ask you something, Colin. Is it fair to say that in terms of structure and the terms of capital that you might provide in a transaction is really sort of the imagination? It's up to the imagination and structure of a deal versus, private equity that has a pretty set type of economics that they have to kind of play within a certain parameter.
Absolutely, absolutely. So on the scale of banks with covenants and short terms and principal and interest payments, on one end with heavy covenants on other distributions, other amounts of leverage that would be allowed, the use of funds, whether it be mergers, acquisitions, dispositions, whichever. So banks have probably the tightest covenants and the most rules. They also demand less in their returns because they usually have seniority on the claim of the business assets, right? They're going to have some type of security interest, first lien, something. Moving over to the private equity part over here, they're going to have, I guess, less generally claim on the assets of the business. They're typically use leverage, so there would be banks involved. And so you build this capital stack up where, now the company, not only does it need to, revenue, plus expenses, payroll, et cetera, debt service, well, the private equity guy is going to need to return on that capital as well because his investors gave them this money to return in a reasonable amount of time and hopefully at a higher risk premium relative to other things that need to be paid, like the business expenses and the debt. So that creates different stress for the private equity investor because they have their own investors and or they're tied into the bank leverage. So the private equity player is going to be pulled in typically more directions as relates to the business. Sometimes, regardless of how well the business is actually performing, maybe they're in a fund and the fund is in a wind down and they need to redeem this asset. So even though the business is doing very well, this particular investor is now constrained and has this need to exit the position to return capital to the investors. So that can create its own stress in a business. So now you mix into the family office. For us, you're exactly right. Creativity is the name of the game for us. We try to be a capital provider that complements the business, whether, for example, we might not require high interest coupons. We can delay payments. We don't have to have some type of fixed payment arrangement. We certainly don't have time fuse where we're going to have a redemption or a capital event. In fact, for us in the family office, it's better for us to find these really good teams and management companies that can compound these dollars over time. So for us, we have reinvestment risk. In fact, if we get our money back, sometimes it's good news. We're not going to go find another good idea, hopefully as good as you guys did for us. So we really enjoy the long-term compounding. But at the same time, we have the skill set as former private equity to do transactions, whether it's more add-ons, raise additional capital, redo the capital stack, the dividend recaps that Jim was mentioning. We have that playbook, but we're not constrained by the typical forces of a private equity shop.
Hey, John, maybe this might be a good time for you to talk a little bit on this case study, specifically on the unique structure and how you bring in the participation of the 100% company that's ESOP owned S Corp structure and how this benefits the existing employees as the company wants to make additional positions off into the future using family office as a capital partner.
That's a great question, Jim. And if everybody would turn to page 23 slide, this would be a good example. And remember, this is a company that is an S corp owned 100% by an ESOP. It is very mature. It has repurchase liability demands on it. It also has a number of acquisition opportunities. And it's important to make these acquisitions if it wants to sustain itself for the next several years. And this company here wants to be a dominant player in the industry. So it's critical they continue to grow organically as well as make acquisitions. So I'll hold up the picture, although you can look at it. What normally happens in family office is you have the ESOP company, but to bring in a family office, it's very important that we drop the assets. In this case study, we drop the assets into a LLC, of which the family office bought some capitals. Again, we're trying to stabilize the capital for the ESOP company so it has significant amount of money for cash flow to use for repurchase liability. But at the same time, we have target 1, target 2, target 3 in the industry that we want to continue to make acquisitions on. So what the family office does, since they're a long-term investor, they can put money in through buying more equity into the operating company, or they can also put additional money into the different targets. Lots of flexibility, much different than private equity would. And so, Colin, when you look at one of these, where do you like to be? I mean, from a capital structure standpoint, we want a good capital structure for these ESOPs because these are 10-year, 20-year future investments, and you become a very valued partner with these folks. So,
ideally, almost without fail, the company as it exists, it's best for your business. And so I think whenever these companies present, and we've had several presentations even recently, they have a very clear idea of what cash needs they have with repurchase liability, but then they're also saying, gosh, guys, I see this other idea over here. I wish I had $10 million. I could do this. And that's really where we can come in and help with that. So again, our plan would be to allocate to the best management teams. So the management team actually knows a lot more about, do we do target 1, target 2? Do we make maybe even a diversifying investment? We can invest in things that not even be related to the business. And so that's where we just really try to be a capital provider that has seen a lot of different deals and just fit in wherever we can, whether it's liquidity and or some type of management support.
and Colin, a question for you and also Jim is, there's oftentimes we'll do these transactions where we're making acquisitions of target company, but we also want to grow organically. So does a family office just ask for more equity? Or are you willing to also make some type of loan to the company that gets paid back over a period of time, or a combination?
We're very flexible. In general, we want to make sure we match kind of the risk to the returns, right? And so if you're going, for example, to buy real estate, that might be easier for us to loan on because then there's easy collateral. If you're creating a brand new startup company, we would probably rather take the risk side of that deal and be an equity investor. So, but we would think certainly with management, dollars are fungible, right? I mean, a dollar that comes into the company, whether it's from me or from revenue, those managers are going to decide, how to deploy those dollars. So we're helpful in that sense. But to your question, debt is sometimes the perfect answer for us, and sometimes equity is a perfect answer. Or there's hybrids, there's convertible notes, participating preferred. There's so many iterations. It's almost easier to look at an example with you, and then we can tell you how we think about it, and then make sure we're aligned.
In working with family offices, I just want to make a note on that subject. There's not a huge credit committee for family offices. Here's a live example. With interest rates raising right now, I've worked with companies that literally they get the term sheet from the debt financing, and literally 5 days before it's supposed to close, the terms change and they end up having to put more equity into the new underwriting commitment. I can tell you that family offices, they don't have those kind of problems. They can make very quick decisions. There's not usually, maybe there's two people. Colin actually makes the decision with Patterson Thoma, but that is so beneficial right now with these rising interest rates and people trying to act on an initiative, make an acquisition, or come up with cash to close a transaction. It's very, very beneficial.
To follow up with that question, to Colin is, one of the things, you talked about this, Jim talked about this, is the whole period. Because one of the things that I think we've struggled with at the beginning when we started bringing in private equity into these deals is they wanted out in 3, 5, no longer than 7 years.
Mm-hmm.
What is your holding period? Are you a real a valued business partner that's going to be with them for 10 years, 15 years if the investment looks good?
Yeah, this really comes down to the principles of what Patterson Thoma was founded on, right? What Dan was able to create, he wants for his children, and he wants for their children and their children. So my time horizon is, where Patterson Thoma's time horizon is as long as your family's time horizon is. I would say it's indefinite. So.
That's the beauty of with an ESOP company is we have this ever-changing employee group. It's generational. Mm-hmm. It's not linear. There's some bubbles, but a lot of these ESOP companies, they've been around for not only 10 years, they've been around for 20 years, they've been around for 30 years, and one of their big challenges, it's always been, is getting the right capital structure in, but at the same time to sustain this culture that they've built, a very successful culture. So, well, we've got 5 minutes left. So, Jim, I've got a question for you. Is we all see situations like this, both of us do. And a lot of times what we see is ESOP companies that are challenged with repurchase liability. They feel like they've hit a dead end. Mm-hmm. And they also feel like their only option is to go ahead and engage an investment banker and auction the business. Mm-hmm. And it could be at the right time, it could be at the wrong time. Mm-hmm. But the biggest fear is the valuation decrease in the bad time. So, and you and I have worked together for a long time. This isn't perfect for everybody, but we've seen some successes. So, what are you seeing in the marketplace with family offices? Is it growing? I know it's new.
It is new. It's a different way of thinking. It's a new strategy. The other thing that I think is really interesting with family offices, because I've represented family offices throughout my career, depending on the capital need, what a lot of family offices like to do is be the lead investor. But if the capital needs are to a point where they need significant amounts of capital that don't correspond with a particular sector allocation for a family office. One thing I've learned about family offices, wealthy guys have friends that are wealthy friends. And so it's a very incestuous group of people that form family offices all throughout the country. And like, for instance, in Dallas, most of them sit in literally the same building complex. Yeah. And so it's very easy if suddenly there's a need that's an additional $10 million, it can be put together in warp speed. I mean, it's amazing what can happen in a very short amount of time. That is such an incredible advantage for a board of directors that's trying to do something strategically. They're trying to do it stealthy. They're trying to do it in a short time frame. And they've got all these things working against them from a time standpoint. That's what I really like about this new trend of reaching to family offices around the country.
I think you have to plug for the Texas family offices generally and specifically even is just the oil and gas nature of kind of sharing the risk in particular oil wells. And that is, Texas has done a great job to diversify its economy. That collaboration has really persisted. And so it's very common for us to invest with other families where maybe they have a real estate expertise and we have a private equity expertise and on down the line. And so that collaboration really makes hay for a lot of good friends, but it does open up the aperture of how much capital you can get, and it is warp speed. And at the same time, we all have institutional friends as well. So, I can think of one example where we started out with, let's call it $10 million, and the next year was twice, and then it doubled again, and we bring in an institutional partner from New York who has twice as much money. And so we do have those connections and the ability to corral those dollars.
Absolutely.
Last question for you, Colin, that I think sets on a lot of ESOP companies' minds and boards, as well as ESOP trustees, is in the family office world. And if you compare it against private equity usually likes to invest on a control basis. From a family office standpoint, what's your view on that? Are you okay being a minority investor? Do you feel like you have to control the board? Do you have to feel like you have to replace the CFO if you make an investment? Tell us a little bit about your views on investing in that manner.
That's another great difference between private equity and family offices. And again, back to the constraints of the private equity investor who needs to be in control of the business so they can have that timely exit. We'll take the opposite approach. If you're better at running your business than we are, we're going to allocate, we'll sit in the back seat. We rarely ask for a board position. We do like board observation rights. We still want to manage our investment and have the transparency and the information flows. But by no means are we looking to take over a company as a family office. We have plenty to do. So we're good.
Well, I think we ought to have some closing remarks here. We talk a little bit about employee ownership, and because Chris and Joseph did a great job with this symposium for years, and I've been honored to be a participant in it. And one of the important things is how do we continue to sustain employee ownership and how do we grow it? And so with our last questions, I'm just going to open it up, and your viewpoint, Jim, with the family office part of maturities. How do you see this as sustaining employee ownership in America? And I'll ask you the same question.
I think it's right now, I think it's in the early stages. But again, because I think it's, correct me with my stats, isn't it like 10,000 hiring? Is it each week or each day? I can't remember, but it's some massive number.
Staggering.
And look, not all those baby boomers own businesses, but 3% do. And so they're going to all have to go through some sort of business succession plan. And just think that it's really going to take off over the next 10 years. I'm very bullish on the marketplace for employee ownership. Hey, let's talk about it. I mean, there's not as many IPOs out there in the marketplace anymore. It's the few exceptions that are really are even in a position to go public. So that's really off the table for most businesses. So that's one less option. And I think that it's just a really good source of capital with maybe a little bit more palatable terms associated with on a family office versus some very defined parameters to private equity. So I'm very bullish over the next 10 years. Which is why I'm now with Morgan Stanley.
Well, Jim, thank you for sitting on this panel. Colin, any closing remarks on employee ownership?
Yeah, it really just reminds me again of the parallels between a family office and ESOPs, where you want your family to have this common mission, and everybody's buying in, and everybody's at the dinner table. In the family office I'm lucky enough to work with, they treat us employees, right? We have ownership and participation. So we believe in it. I love ESOPs. I love seeing how just the sharing of the economics, right? Because you don't have to be, C-level executive to drive change or value in a business. And so top to bottom, to have everybody row in the same direction is so valuable. And it means a lot to be able to work with families and companies like that.
John, one last thought.
Yes.
I get so much pleasure because we educate a lot of these employees that have retired, and suddenly they have $4 million
Yes.
that they have to manage. And I can't tell you how much joy I get in seeing a guy that's worked 30 years making widgets on an assembly line, and suddenly he has money in his account that he would have never dreamed of. This company's worked hard. He's participated in the success of the company, and suddenly he has this massive amount of money in his bank account. I mean, I get a lot of satisfaction out of that.
And Jim, I think that's a wonderful thing. And, in closing, one of the things that's been really exciting to me to be part of this investment plateau using family office is it sustains a great company. It also preserves the culture of employee ownership. It creates a lot of wealth, not only for the first generation, second generation, but the third generation. And it gets the right capital structure in place so the company and the future generation can benefit from it.
Absolutely.
And most of these companies are leaders in their industry. And it's very sad when a great ESOP company is forced to sell because of repurchase liability. Now I think there is a new alternative.
Yes.
So with this, I want to thank Colin. I want to thank you, Jim. I want to thank you. It's been truly a privilege and an honor to be serving on this panel with you. Also want to thank Chris Michaels for arranging this, and hope everybody has a wonderful symposium. Thank you.